There you go.
All
We'll
right.
leave it at that. Yeah.
We'll get everybody in.
So Dominic, where'd you just come back from? Or where were you just now? You said you were just traveling?
Yeah, I was in Montreal. Went to see my folks.
Oh, okay. Not some conference somewhere.
No. I'll be at the Western Secondary next week. So I'll see you there. The only place I get to see Rob now is at conferences, airports, or on a call like this. We used to hang out quite a bit more. I miss those days.
I'm supposed to play tennis Sunday for like a little charity event Sunday afternoon, but I reserved a court today, and the fellow I was talking to on the phone in Dana Point there in Orange County said, we're supposed to get more rain on Sunday than like we get all year, or something like that. So I don't know.
I read that in your blog, and then I was telling Melissa, a customer already canceled, that's coming from Chicago, already canceled a meeting. They're afraid of that storm that's coming through. That's supposed to come up. So I guess I need to read up about it and see what happens on Monday when we get on the flight.
Yeah, we have one of our teammates that's going to be at Western Secondary too. We'll have to keep our eyes on the storm.
Who was it? Was it a lender from Chicago, Dominic? Or
yes, guarantee rate. Yeah, they have a team coming through, coming to the Western, and then capital markets guys. And then one of them just canceled today. He says, well, I don't want to deal with I assume there'd be flight delays and stuff like that. I don't know. This is the first I've heard. It's a named storm that's coming off the south. So I don't know how bad it's going to be.
Just some rain. Just some rain.
By the time it gets to us.
Cause some havoc though. Well,
yeah.
I'll go ahead and kick us off. Can I kick us off? Is that okay, Rob?
Sure.
All right. Well, welcome everybody. I'm Melissa Langdale, President COO of the Mortgage Collaborative, joined today as always by Rob Chrisman, the distinguished, brilliant Rob Chrisman. I'll have to come up with some other titles for you over time.
Yeah.
And
has been.
No. And the distinguished and brilliant Dominic Lavoie. Did I say that right?
Perfectly. Thank you.
Yay. The Managing Director of National Accounts for National MI. Dominic, thank you so much for joining us today. Excited about spending some time with you and talking about kind of mortgage insurance. But before we get kicked off, as most everybody here knows, this is not my normal Friday attire. I am wearing a cowboy hat for a reason. We at the Mortgage Collaborative have a conference coming up in Nashville in September for our members on the call. Would love to see you join us. We have a ton of fantastic content and speakers lined up. So that is my Nashville pitch today, and y'all get to see me wear this hat because I can't take it off at this point today. But also, if you've not subscribed to our YouTube channel or our podcast, just search for TMC Connect in the podcast as well. Dominic, thank you so much for joining us again. Have appreciated your kind of partnership over the years at TMC, and would love to maybe have you spend some time talking about National MI and kind of your role there.
Yeah, thanks for having me. I've been with National MI for about over 6 years now. I'm here in place of Don't Measure To, the famous Susan Schaefer, that is the representative for National MI with TMC and their partners. She actually completed the School of Mortgage Banking 3 this week out in Washington, and she's on her way back home. So here I am as a sad replacement for her, but hopefully I'll be able to bring some insight as to how we can partner, how we partner with our TMC and lenders from an MI perspective and so on. So looking forward. Thanks for having me again.
Absolutely. Rob, do you want to kick us off today?
No.
Okay.
I shouldn't say it. No, I've got some questions. Can I call you Dom, or you want Dominic?
You always have. You're good. Hey, but I've been called worse along the way, so Dom is perfect.
I know. Well, we could talk about some hockey stories, but you can save those for the TMC event. I think Melissa, echoing your comment about the Nashville conference, I was just on a call with Tom and the economists, and I'm fortunate to be able to moderate that panel. You got some heavy hitters coming to Nashville, so congratulations on that. I'm sitting here on this call talking to the other panelists thinking, what am I doing on here? But Dom, I wanted to ask you, there are certain parts of mortgage lending which are, I won't call them backwaters, but they're kind of quiet. They're kind of doing their thing until something happens, and then all of a sudden they're in the spotlight. The best example earlier this year was the world of credit, and suddenly the prices go up, and suddenly everyone's saying, holy smokes, what, soft pull, hard pull, how are we going to contain our costs? Mortgage insurance is kind of just is there, and it's obviously helping lenders help borrowers day after day, week after week, month after month. What if anything do you think has been a big change in the last, you've been there 6 years almost, you said. How have things evolved from your perspective from an MI in the MI world for lenders and borrowers?
That's a loaded question, right? I had an earlier conversation with Melissa and shared with her a response from USMI to comment on LLPAs, proposed LLPAs, and it's kind of a framework around single family mortgage pricing framework, right? If you go, you almost have to take it back to the crisis, right? 07, 08, and how we came out on the other side of it. There's now this thing called the private mortgage insurance eligibility requirement, called PMIers, right? Where it was basically a mandate to strengthen all the MI companies out there that dealt with the GSEs, right? We changed our entire master policy language to strengthen the language, to make sure there was no gaps into what our responsibilities were and what the lender's responsibility was. So there's capital requirements attached to that and so on. So now as we move, to answer your question, as we move forward, and we have, the biggest topic right now is affordable lending, right? Underserved communities and things like that, where, FHFA or the GSEs will come out with new programs and so on. And often, unfortunately, sometimes do not have a direct conversation with us up front. And this is where the lenders, one of the first calls the lenders will have and say, hey, will you insure this program? Will you do this? What's your assessment of the new guidelines that came out from the GSEs and so on? So we're directly connected in multiple ways. There is a big machine that works in the back, with the GSEs, or we're directly involved or impacted when they make changes, LLPAs being one of them, right? So, for me, it's one of those things where, the answer from USMI highlights the need for being involved in early conversation. And I would even push that they should have the early conversation with everybody that's impacted, which is some of the lenders out there that would, give them a voice to, are these things make sense? The programs, are well intended. The execution sometimes is not as easy as as we would like it to be, but it does impact multitude of segments within the industry. And I think earlier education conversation would maybe help with the outcome, or the willing outcome of what we're trying to accomplish here.
The LLPAs, we talked a lot about kind of MI's role in that, and kind of whether FHFA really, had effectively kind of calculated for the way that MI is structured today. And I think a lot of, loan officers are aware of like the pricing differences and how there's like risk-based pricing changes over the last couple of years in MI, but may not have understood like all the other things that went on behind the scenes and that relationship with GSEs and how MI has really changed over the years to kind of provide some extra stability and mitigation of risk to those entities. Are you, do you feel like, there's still opportunities in the LLPA framework for the way that MI is structured today, and how it's kind of able to mitigate risk? Could that change the framework at all, I guess is what I'm asking.
It can definitely help, right? Just this morning, right, I saw something around requests for comments around the G fees, right? And they're wanting to revisit that and getting comments from folks, right? So there's a fee there, right? And it's based on risk. Well, if you look at the LLPAs, especially above 80% LTV, right? And this is kind of why I brought up the PMIers and the reason why for PMIers and the financial requirements that are put on the MI companies. So above 80, we are in the first loss position, right? So, you have LPAs above 80, as you increase, the LTV, the LPAs are adjusted as well. But you have a first position partner that is built now to make sure that we take care of the losses in first position. So, where, can we work with this, right? Again, if we talk about the affordable lending piece of it, most likely on the affordable underserved communities, LTVs are going to be higher. How do we work with LLPAs and your recourse companies as far as, losses is? We all want to do something that's sustainable long-term. We all want, call them performing loans with sustainable lending, affordable lending. We all want to be part of it. So there's something, and again, I'll say education and conversation with everyone, and to make sure that we do what's right for all parties involved. I think there's room there to grow.
So, Dominic, we're gonna go off script. Ready?
Yes.
Okay. And I realize you may not be able to comment, but I'm involved with, I'm a senior associate of Stratmore Group, and we have these peer group meetings with the MBA and with Stratmore, and we sit around with a bunch of lenders, whether they're banks or credit unions, mid-sized, large banks, independent mortgage banks, whatever. And we talk about the industry and we talk about performance and so forth. And the MBA is very clear at the outset of these meetings that there's no collusion, collaboration, there's no secret sauce sharing. There's, it's a, none of that's going to happen. No talking about pricing, that kind of thing. When you are interacting with other MI companies or reps from other MI companies, it's a relatively straightforward product, but each company has its own quirks, its own nuances, its own character, as it were. How much shop do you talk when you're in a room, when you're hanging out at the bar at the Western Secondary, and maybe you've got somebody from Arch to your right and somebody from Essent to your left? Do you all have the same problems? Is it all the same kind of issues? Do you talk business much? And if so, what's a conversation between MI people like?
That's a great question. I'd like to think, and I'm actually proud of this, I think in the MI space, I would say that we have some of the ultimate professionals, within it. And I'm friends with many from other companies. So ultimately we are salespeople, right? We are competitive. And some of the conversation around the business is the same issues, but different, right? Of course, the head of our risk or pricing and all that have different visions and appetite for risk and so on. And that's how, they address it in their own particular way. From a sales standpoint, right? We're all competitive. We do this. How do you do this? How do you do that? But without giving out the secret sauce. Because again, if you look at the earnings calls, you can see that our approach or appetite is different from one company to the other, and it's reflected in the earnings calls as, you know, our CEOs express their views on those calls. But, you know, like I say, at a conference next week, probably run into a bunch of them. We exchange things. Ultimately, and I'll say this, it may not sound right to some, but we want what's best for our customers. So we're not against helping each other out for the benefit of the TMC and its members, so long as they get the right outcome. Ultimately, there might be a time where I can't do something, but I will refer another partner to make sure my customer is taken care of. So outside of getting into the legalities and the pricing methodology, everybody calls it the black box, what's inside the black box and so on, we do share and utilize a consultative approach to what we do, keeping in mind that we're all competitors as well. And then that's kind of, but I've made friends within the other MI companies. I've had a great time hanging out with them and stuff. And I say, as an industry, we're pretty strong. And I like the fact that I'm part of one I can call that most people are extremely professional.
Good. That's good to hear. Go ahead, Melissa. Sorry.
No, that's okay. I was going to ask, to kind of build on that. One of the things that, I think of when I think of MI, right, is our, most of the time kind of insuring over 80% LTV, right? So you have appreciation rates, right? Home values have gone up pretty dramatically over the last couple of years. You have a lot of people staying in their homes for longer as a result. I'm curious, as you're talking to your kind of peer group in the industry, is there a pulse of like an increase in cancellation rates as a result of just equity positions that people have today? Is that like a holistic thing, or is that just my feeling on the market?
No, I mean, it's kind of picked up as rhythm, right? So if you can go back as far as 2018, when market, we'll call it more normalized, 19, 20, we just gone through the pandemic period, right? It was abnormal. I think we hit somewhere around, Rob is the numbers guy, but the 4 trillion, right? And this year we're going to be somewhere around, I believe I think it's 1.5, 6, 7, or 8, whichever, right? Which is normalized. So the cancellation, right? Of course, we've done more loans in 20, 21, 22, which the cancellation rate might increase. Values have gone up, but at the same time, interest rates have gone down. People are not going to refinance, and all this kicks in, right? So I'd say it's probably normalized, right? There's no extreme right now as far as cancellation. And then this, you and I talked about this. So one of the questions that will never stop coming back, how do you cancel a mortgage insurance, right? So the basic rules are, if through amortization, if you hit 80% of the original value, you can request for the MI to be dropped off. The basic rule as well, through appreciation, is a minimum of 2 years that the MI needs to be on the loan, right? Through increase in property in value. One of the things that we always talk about, the MI companies are not in charge of canceling MI. It is up to the investor and the servicer to request this. I take home premium, I insure loans. When the premiums don't come, we no longer insure the property, right? So that's one of the misconceptions out there. The MI company is not in charge of canceling MI. The servicer is. So you always have to look at the investors and their rules as far as canceling MI. But when we talk about the GSEs, these are the basic rules. It goes back to the Homeowners Protection Act, I think 1998, where at 70% through amortization and the original value, the MI has to be dropped off by the servicer. So long as, again, payments are the payment history is clean and so on and so forth. So always check with your investor.
So, Dom, let's go off script again. So I hear rumors. I've never seen it firsthand, but I've heard rumors that there are different reasons why an MI premium might be different. Maybe you could talk about how an MI premium might be different, and do they differ by, you and I right now are in California. Does it differ by state or area code? I don't know, town, or what are the variables that go into, generically speaking, MI pricing?
The best way, so we're an insurance company, right? Monoline insurance company. So that's what we are. I carry a property casualty in California fire license to be able to sell mortgage insurance, right, within the company. My best, how to relate to this is auto insurance, right? How many things, right, they look at, and I'm not saying this applies to mortgage insurance, but all the above that you mentioned, Rob, is encompassed into the pricing methodology. Things that do matter, of course, the FICO and the LTV and the DTI and so on and so forth. It's truly now the MI industry has the ability to do a true risk assessment, and based on the methodology, how they see risk, price it that way. I brought up the PMI's financial requirements. There's capital charges for, how deep we go into the risk spectrum, and talking about, per GSE guidelines, right? Is it a 97? Is it a 95? Is it an 85? And there's different capital charges for that. That needs to be applied to pricing. So all of the things that you can think of, right? Overly or excess increase in value in certain counties, right? Then there's a fear that the price may drop. So we insure in the go forward basis, not what's in the books already. We can't change those premium, but going forward, is there a fear? Is there unemployment fear? Is there value fear? Is there this? Is that? So we need to address these things on the go forward, not what's happened in the past, but go forward. So all of this gets put in, and that's why people love to say there's a black box. Nobody knows what goes on into that. But I say it's no different than what truly should be a interest rate on any given loan. A lot of it is risk based as far as what the interest rate belongs to what loan. I think we do the same, but now in the past, you had the old antiquated rate cards, and you had, for this LTV, this FICO, you had specific price. Now it's definitely a lot more granular between all these boxes. So it's basically, like anything else, a rate card on steroids, where now you would have, multitude of scenarios, not just, one that would fit on a static rate card.
Yeah, I was up until yesterday morning, I was in Las Vegas at this Originator Connect event, and several of the attendees asked me about loan level price adjustments. When are they going to go away? When are they going to, when are they going to stop? When are they going to go away? And I would remind them that the loan level price adjustments are based on data. So I'll give you a quick example, and I know this is your show, but I want to, put this out there. So I remember, and I'm going to sanitize this to a great degree, but let's say a new correspondent investor popped up several years ago. And let's say the condo hit, say at Wells Fargo or Chase, was a point. Just making that up, a point hit if it's a condominium. New correspondent investor pops up and they only have a half a point hit. And so people would write to me and say, why is new guy at a half point hit, Wells Fargo's at a point hit, Chase is at a point hit, what gives? And I would say, well, Wells Fargo and Chase have this historical perspective. They have suffered throughout several business cycles losses on condominium loans. And so they feel that a point paying a point less makes up for that loss that they anticipate for condominium loans, plain and simple. And like I say, I'm simplifying this quite a bit. And the fact that the new company that came along is only at a half a point, maybe they don't have the historical perspective of the servicing portfolio of several $1 trillion that Wells and Chase have. But fine, send them, send your business to the new company. Go ahead. But what tends to happen is over time, the new company says, oh, we've been valuing the risk wrong, or suddenly their floodgates open and they get every condo loan out there because they're a half a point better than their competitors. And then they change just to match to slow things down a little bit. Is that a good way to think about it in terms of the mortgage insurance premiums?
Absolutely, right. We are, we have analysts and actuaries and that look at, the only thing you can look at is is the history, right? That's why, it's hard, or we say we need to have a longer conversation around, for example, the SPCP program that the GSE wanted, rolled out or wanted to roll out, and how they did it, where there's no history as the performance of these loans, right? If we're really into the sustainability of home ownership and so on, we need to have data. So that's a nightmare for a actuary to be able, to try to price something on the go forward when you don't have the history to back up, data to back up your decision. So that's exactly what you're saying. Somebody, when we come in, and then we get into, for your example, you get in a competitive environment. So it's not necessarily maybe a risk assessment as to taking on these loans for a certain price without adjustments and so on. Once they realize, oh, okay, so they're probably adversely selected because of the better price. Maybe they wanted it for a competitive reason, but once they make the risk assessment and what can come later on, then they make the adjustment. So, that's principle of insurance as well.
What advice would you give a lender in communicating with their MI companies? And I ask that because this year has been a tough year for many lenders. Maybe they'll make money 1 month, lose it for 2 months in a row, make a little, lose it. It's hard to put together a whole successful, profitable quarter for many lenders. And so I encourage lenders to talk to their warehouse banks weekly, if need be, to say, hey, I know we lost money in July, but here's what we've done in August. Here's how we look so far, in order to keep that communication going and that relationship, up to speed, because you don't want to cut ties with your warehouse bank. And yet many lenders are in effect in violation of their warehouse covenants because they are losing money. You're not supposed to do that. How do you appreciate lenders talking to you on a daily or weekly or monthly basis? How often, and what are the subjects that you guys cover typically?
You're right. And these are our relationship, right? We're part of we're not part of their every single loan that they produce, right? We're part of a segment of their loans, right? We insure on a flow basis each and every loan that need mortgage insurance. But when I talked about consultative approach to what we do, we are attached to multiple segments within the industry that do impact us, right? We want our customers to do well throughout the chain. And it's the same thing. I think then it goes back to the education piece of it, right? So you talk about, if I own a mortgage company, I would want my loan officers to be the ultimate professional, understanding every single product that I have to offer out there, which include MI. But I don't expect the loan officers to be expert at MI. So therefore, build a direct connection with one of your MI rep to really serve your customers with the multiple option. I think there's still there might be some occasions where that helps you bring in more volume and so on, and making sure that you take care of your customers in the early phase. Again, we're talking about affordable lending, right? why not get involved with customers at the, future customers at the high school level with education program to make them understand what the process, so that when they're ready to, to borrow, they'll come to you. But again, you have such a grasp of what the programs are available out there that you can give them option and place them in the right program. As far as, making ends meet, this is the conversation. You need to engage the GSEs and let's discuss LLPAs. Is it overdone when you do an LLPAs at 90% when you have built a strong counterparty risk in the MI companies that will charge on a risk-based basis the right price for that loan to make sure that there's no losses are incurred by the investor. So those are the places where there might be some savings, right? Because the first reaction to what you're saying, they've come around, right? They've come to the credit provider. They've come to the insurance. Can we find some relief? Can we find some relief? The rates basically, the way we price as MI companies, we are also overseen by the Board of Insurance of the states where we're domiciled. So playing the rates is not I'm forgetting the word, but it's set, right? It's regulated and so on, and we come up with the price methodology and so on and so forth. That's non-negotiable basically, right? So, but once you've gone through the negotiable costs and things and your operation, your efficiency and so on, that's pretty much where the conversation is as to how you operate going, trying to be profitable going forward.
We have one question that I want us to get to. Deborah Holt asks, why do community banks and credit, I think she meant credit unions, receive lower premiums than mortgage lenders? And I'd love to hear your thoughts.
Yeah, Dom. Yeah.
So I've skated for most of my life, so I can skate around anything.
Dom, how many times have you used that line?
Without, like I said,
how many times have you used that line?
I love, like I said, I'm friends with many other MI companies. What I will say, since National MI is on the show, this is not happening at National MI. So it may be true of others that present programs, but when it comes to National MI, it is a true risk-based assessment based on the particularity of each and every loan. So I will say that as a salesperson, I don't make a difference between a credit union, a community bank, or a independent mortgage banker.
So there we heard it. It's not necessarily universal.
It may not be. I'm not speaking for the industry, just for National MI.
Yeah, but I mean, if I were, I'm not going to come to your defense because you're not doing anything wrong, right? But if I'm an MI company, if I'm an insurance company, I mean, look what's going on. You talk about California or Florida, hurricane insurance, forest fire insurance, homeowners insurance in Florida and California. It's deteriorating like by the month, and the the insurance companies are saying, hey, we're basing it on risk. We don't want to. Dom, you're up there in El Dorado Hills, you're in the foothills. I'm here in San Rafael, surrounded by trees. Hey, we don't want to insure you, so find somebody else. I think that it's based on, I go to Home Depot, and there's a contractor in line behind me, and we're buying the same thing, but he's a contractor and so he gets a better deal. I mean, that's how Home Depot works, right? That's how car insurance works, housing insurance. I mean, it's very prevalent. So anyway, for those other MI companies, not National MI, of course.
No, you're right, Rob. I mean, I just got, I've seen insurance companies now, just flat out walk away from California now because of the fires, right? And I went through the scenarios where my insurance company said, basically, it went from, for the house insurance, 2,000% increase. I'm like, whoa, 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 I'm not in the fire zone, right? We've never had a fire and so on and so forth, but they just lump you into some, again, it's just, you say, well, if you want insurance with us, this is what you're going to pay. So then, it sparks another conversation. But yeah, I would say we're heavily regulated that way where, we're not adversely selecting, customers or things like that based on things that should not be part of it.
Yeah.
I left you with the hardest question last. So thank you for helping us to navigate that.
Well, I mean, so to reiterate what I just said, it's part of life. If I'm a buyer of grapes for wine, the grape grower is going to give me a better deal if I'm consistently there every year because of that relationship. So, I mean, it happens everywhere, right? Everywhere. You buy a lot of shirts from a t-shirt manufacturer, they're going to give you a discounted price. It used to be where companies like Countrywide would have a great G fee, guarantee fee from the agencies, and companies would get together at conferences and say, what's your guarantee fee? Well, mine's 20 basis points. Well, mine's only 18. I mean, there were differences there. Now supposedly Fannie Mae and Freddie Mac offer the same G fee to everybody, I guess, but it's still, pricing differences exist everywhere. Melissa, you go into your local AM PM and the guy there knows you and you don't have your wallet. He's like, oh yeah, pay me next time. I mean, it's just part of life's fabric to some extent. And I'm, that maybe or maybe not, that may or may not happen, but on a large scale, companies should price things based on their risk. And if they don't price something accordingly, then a lender, for the most part, oftentimes is free to go somewhere else. Right. Somebody, branch or loan officer or somebody doesn't like National MI's pricing or Essent or radio, whoever, they can use somebody else. So, all right, I'll get off my soapbox.
All right.
Spouting, I'm channeling, somebody pointed out this is actually Winston Churchill's autobiography for World War II behind me, which it is. And, different time, different place, but it's almost buyer beware kind of thing. And that's why, Dom, I asked you the question about communication and lenders talking to you on a regular basis to try to figure out what's the most advantageous relationship to have with, in this case, National MI. How can we help you and you can help us?
Yeah, like I said, we're involved in so many things, right? We've brought lenders together, right? This is one of the things we do. I love the quote from Jerry Maguire: "Help me help you," right? If I don't know there's a problem, I can't fix it. But when you come to us, and oftentimes is exactly that. People operate in silos, but when we come together as a group, I'm a firm believer in team game. And I actually, Rob was part of when I started early on. I would love, like around Christmas, bring all kinds of lenders and service providers together into one space, say hi and get to know each other. Because I always said that you never know who you're going to need, what you're going to need, and where you're going to be down the road, and then invite somebody like Rob to join us. This is exactly it, right? You may have a community bank or a credit union that has a portfolio program that's looking, for customers. Well, we can connect the two together, right? Or somebody's looking for a program. Do you know somebody that offers this program? And we try to connect people together, right? Again, of course, they're competitors, but I think as a whole, everybody's trying to do what's best for their customers and how to go about it. And we're kind of the connectors to this, right? We do a lot of, we have the National MI University where we help you train, somebody maybe working at the front desk that would like to get involved in the business, and with starter course with processing, underwriting, and so on, that you can train from within, right? We offer third-party training, for sales, for operation, for service, and so on and so forth. So again, it's how do we help and connect people? And again, I think communication and training is a big part of what we do that doesn't show up in the front end. But I think people that do it well in the back end or in the front end show a better back end as to production and the stability of the business and so on and so forth.
Nothing like a good back end.
On that note, happy Friday, everybody. Dominic, thank you for joining us today. Thank you for National MI and for everything that you guys do for all of our members at TMC. Really appreciate the partnership and your time today and your expertise and sharing that with us. I hope everybody has a fantastic weekend, and we will see you next week. Bye, everybody.
Thanks, Melissa. Thanks, Tom.
Thank
Bye.
you.